Hi guys, my name's Aaron. I'm the author of Value Investing Substack. Please visit my blog at valueinvesting.substack.com, um, where we discuss all things value investing and ASEAN stock ideas. So, as some of you may be aware, ASEAN is poised to become the next China because it will be where the global manufacturing center shifts, right? After China, slowly graduates into a developed nation. So basically the gist of my blog is to provide stock ideas in the coming quote unquote coming China over the next 30 years. So if you miss the past 30 years of the China economic miracle, well, here's your second chance. So the reason why I'm doing a video today rather than my typical written reports is because Substack just launched a new video beta. So I just thought about giving it a try, right? And I uh, just wanted to try it out on a more light-hearted article. So I typically write ASEAN stock reports and uh, uh, value investing articles catered towards the institutional crowd. But I felt that there was also value that value investing could add to the non-institutional investor. So if you're listening to this, right, that I hope this video adds value to you. Um, so for those of you who are coming here for the first time, as we mentioned, this blog focuses on value investing and ASEAN stock ideas. So if these topics interest you, please feel free to subscribe using the subscription button below. And to my existing subscribers, thank you very much for following me on my journey so far. And a special thank you to my paid subscribers, right, who I'm especially grateful for. Uh, for helping me provide value to everyone, right? So without further ado, let's get into the topic of this article, right? This post. So the topic of this video is how to create $1 million stock portfolio with value investing. There are a few assumptions. Firstly, this will take 30 years, right? So value investing typically is a very long-term oriented investing strategy. So it shouldn't be a surprise that this is supposed to create a $1 million stock portfolio over the long term, right? And the reason why I choose 30 years is because this was intended originally to create a retirement portfolio for myself. So as you will see later, these are very realistic steps you can take towards building a retirement portfolio for yourself over a long period of time. And the second assumption is that this doesn't actually require you to sacrifice much financially. So while pursuing this value investing strategy to build $1 million stock portfolio, it does not require you to give up owning a house or owning a car, typical status quo investments, right? Most people will be contributing the majority of their take-home pay towards mortgage payments, so that at the end of 30 years, you will finally own your own house and not have to pay rental payments every month. Well, the beauty of this investing strategy, value investing strategy, is that it does not require you to sacrifice anything in that regard, right? What I'm trying to deliver is a value investing portfolio on top of your traditional retirement investments, such as your house or your car, right? So I'm not saying that you need to allocate the capital you would normally make towards mortgage payments to this value investing portfolio in order to effect $1 million stock portfolio at the end of 30 years. No, I'm saying that on top of your traditional investments in your house or your car, you will also be able to create another value investing portfolio worth $1 million at the end of 30 years. Sounds attractive now, doesn't it? So, of course, it may require you to save a little bit more in order to allocate towards the value investing portfolio, but nothing crazy, right? You may have to give up, buying a new iPhone every year, or maybe going to your dream holiday destination on expedited timeline. But I would argue these are qualified as luxury expenses, not necessarily super challenging to sacrifice. And if the reward is a value investing portfolio, which allows you to retire with $1 million after 30 years, I think that's a reasonable ask to make. And the third assumption is that this $1 million is not a nominal amount of $1 million after 30 years. It's a post-inflation amount of $1 million, right? So as you know, inflation erodes the purchasing power of your money every year. So historically, the CPI is between 3% to 4%. Now we're seeing temporarily high, 5 to 7% inflation rates. But um, typically over super long time periods like the 30 years I'm demonstrating here, inflation tends to average out, right? It has peaks, it has valleys. So 3 to 4% is quite a reasonable assumption going forward. As we have seen, in the 70s, there was even higher inflation than today, but it still averages out, right, to a 3 to 4% historical CPI over the long term. So if we assume a 4% inflation, right, the post-inflation purchasing power of this value investing portfolio will be over $1 million. That's what I mean, which means it's at least $3 million, right? Nominally speaking, $3.3 million. So these are the three assumptions. Hold these in mind. And without further ado, let's get straight into it. So as you can see, this is the Excel sheet which shows the model of the value investing portfolio that I'm trying to build over 30 years in order to create that post-inflation $1 million portfolio. All right. So this obviously value investing typically invests in stocks, and the assumption is that value investing can give you a 15% return every year, right? And if you actually take the time to read my other articles about value investing, you will understand why I'm so confident that it can actually help you achieve a 15% yield every year. So let's just hold these assumptions in mind, and I will be taking you through this financial model from scratch. Right, I will be building it in this separate sheet, Excel sheet. Okay, so feel free to, while you're watching this video, also open a separate spreadsheet, and follow this exercise so you can see how I will build a financial model that will deliver you a value investing portfolio, which will give you a $1 million nest egg, right? Post inflation after 30 years. All right, excited? Let's start. So the first thing you can see here is that there is a $500 figure here, right? Okay, sorry, let me just delete this for. Okay, there's a $500 figure here. This represents the monthly savings you have to make and invest into the value investing portfolio, right? So let's say you just came out of college, right? You're 25, okay, and you just got your first job. So you typically be earning, I'm not sure, probably between $2,000 to $3,000 a month. And what I'm asking you to practice here is basically the personal finance principle of paying yourself first, right? Some of you will be familiar with this. For those who are not, basically it means that rather than treating your entire take-home pay of $2,000 or $3,000 and using it for expenses, you should pay yourself $500 in savings first, or rather you could pretend that your actual salary is between 1,500 to 2,500, right? So if you have a $2,000 salary and you pay yourself $500 saving first before you pay your other expenses, you end up with a $1,500 salary. Likewise, if you had started with a $3,000 salary and you pay yourself a savings of $500 first, you would pretend that you have a $2,500 salary. Okay, so I'm not going to go into the personal finance side. This is a value investing strategy. So if you would like to know more, please Google and find out more about the pay yourself first principle. Let's get into this. So this strategy, right, assumes that you can save $500 every month and invest it into the value investing portfolio that we are trying to create here. So as you can see, it's $500 per month, and there's 12 months in a year, right? So at the end of 1 month, sorry, at the end of 1 year, you should be able to save $6,000. Okay, so are we following so far? So again, right, we have $500 a month of savings, and we are saving it for 12 months uh, for 12 months in a year, right? So that results in a $6,000 of savings a year. Okay, um, let's add some adjustments. So we're going to copy the $500 here. As you can see, there's a column here called savings. So we'll see why this is useful later. And this 6,000, right, which was the 500 times 12, is actually supposed to be here, right? So this add column basically represents how much you are adding to your savings every year, right? The brought forward column here, BF, represents how much you bring forward from the previous year, basically the balance of your previous year brought forward to the current year. So since we are just starting out this year, your brought forward balance from year one would be 0, right? It's quite normal. And here we are assuming 15% return every year from this value investing portfolio. Again, I would invite you to read my other value investing articles if you would like to know how this can be achieved. But for now, we're just going to assume from a mathematical standpoint. So we're going to copy this, right? And it's 15%. So naturally, the yield, which is the return, the annual return on your brought forward balance of 0, right, would be 0 as well. Okay, so that's represented by a dash in Excel. And the carry forward figure would be the brought forward figure of 0 in year 1 plus the savings you have, the additional savings you have contributed, which is 6,000 in year 1. Sorry, yes, plus the yield. All right. So since the yield this year is 0, right, we can obviously the carry forward figure would only reflect the savings we made in year 1. Okay, so right, let me just tidy up the formula a bit. All right, so this is quite straightforward. All right, so we'll come to this column later. Okay, these columns later. So as we have seen just now, the brought forward in year 2 would be the carry forward of year 1. So we will just be doing this, right? And then we are going to be earning the same 15% yield in year 2. Whereupon, right, we will have a $900 yield for year 2 because we are basically taking $6,000 carried forward from year 1 and we are investing it in we're earning a return of 15% on it, and that results in a yield of $900 for year 2. But on top of that, we will still be adding an additional savings of 6,000. Okay, so let me see. Okay, so this one would be this one. Okay, right? And again, the carry forward will represent the brought forward plus the yield in year 2 plus the additional savings in year 2. So at the end of year 2, we will have a carried forward balance of $12,900. And we will rinse and repeat, right? So in year 3 is basically the same thing. So Excel actually is very nifty. It allows us to drag, right? And we can see, just double check the figures. Yes, we can see how we get a 20,835 carried forward balance in year 3 as represented by the brought forward balance in year 2. The yield of 1,935 right? Which is 12,900 multiplied by 15%. Okay, sorry. Yeah. And an additional contribution of $6,000 in year 3, right? An additional savings into your value investing portfolio. So the blue plus the red plus purple added up gives you a total carried forward balance of $20,835 by the end of year 3. And we're just going to do this in year 5, right? So we just drag. If you've used Excel before, you'll be familiar with this operation. So by the end of year 5, we should end up with a $40,454 carry forward balance in year 5, right? So just to recap, this basically is initial $6,000 contribution, right? Saved, represented by a savings of $500 a month, right? Paid to yourself first into your value investing portfolio, right? Which earns a 15% yield each year, right? Starting from year 1. And you are contributing an additional $6,000 every year to the value investing portfolio. So this will result in your carry forward balances, which will become the following year's brought forward balance, where you repeat the process and you end up with a carry forward balance of 40,454 by year 5. Okay, so now let's come to these 3 columns. So what are they? These 3 columns, this invested column basically is, right, how much you invest this year. Okay, so you are investing $6,000 this year, and you will you are investing $6,000 for the next 5 years, right? 1, 2, 3, no, next 4 years. Okay, so the cumulative amount you have invested over the past 5 years would naturally be the sum of these figures, which would be $30,000, right? So the question, sorry, so the cumulative percent, so this is the annual percent, right? We've seen it's 15%. But what's the cumulative percent of the return you made? It's simply, right, 40,554, which is the year 5 carried forward balance, divided by the cumulative investments you've made over the past 5 years. So that's 135% return, cumulative return, right? So this is all quite straightforward. If you need a refresher, just pause and rewind as according to your own pace. Okay, but let's move on. So naturally we'll be doing the same thing for year 6, but we will be making one small adjustment. And that adjustment is that we'll be doubling the savings into your value investing portfolio. So it would be right, your $500 savings multiplied by 2. So we will be saving $1,000 from your take-home pay into your value investing portfolio per month. Okay, so now you might think that this is a huge jump, right? It's doubling in 5 years, but actually it's not, because presumably by year 5, you would hopefully also have doubled your salary by then, right? Or at least, maybe increase it by 50%. So contributing an incremental $500 to your savings is really not too challenging of an ask, right? So this is actually a very reasonable assumption, right? It should not change the ratio between your savings versus your take-home pay by too much. Okay, you should still be able to save at a comfortable rate. So now we're doing the same thing, right? So we're dragging this year 6 as we have dragged for before, with one change, right? Which is that we are using this $1,000 per month of savings multiplied by 12 months in a year. We will get $12,000 per year of savings. So this results in additional savings being contributed to the value investing portfolio of $12,000 starting from year 6. All right. So if you this isn't too challenging, let's move on. So we will just drag this to year 10, right? In a very similar fashion as we did for the first 5 years, in the following 5 years, we will come to an final carry forward balance of 162,000 in year 10, right? So naturally, right, this would also be $12,000 invested per year, right, for the following 5 years. And if we were to sum this up from the beginning, right, your total investments made from year one would be 90,000, right, which is 5 years worth of 6,000 of savings per year, and another 5 years worth of savings worth 12,000 per year. Okay, so again, the cumulative amount is 180,000, which is just your final carry forward balance in year 10 of 162,277 divided by the cumulative savings you have made up to this point of 90,000. So, right, that's a cumulative return of 180% on top of your cumulative investment so far of 90,000. So you know the drill by now, right? In year 11, we'll just be doing the same thing. We'll be multiplying this by 2. And again, right, you should ideally be doubling your salary once every 5 years, or at least, increasing it by 50% a year. So, this is just an incremental $500 from when you started, and this is just an incremental $1,000 from when you started. It's honestly very realistic, right? I've practiced this myself and I can do this. So, right, we're going to the next one, and we're just going to change this to, right, $2,000 of savings into the value investing portfolio per month, or $24,000 of savings into the value investing portfolio per year. And this will give us, right, a carried forward balance of $210,618 by end of year 11. So, right, we're just going to do the same thing and end up with a carried forward balance of $488,213 at the end of year 15, right? And similarly, we're contributing additional $24,000 per year for the next 5 years, resulting in a cumulative investment of 210,000 in the first 15 years, right? And this might sound like a big figure, but keep in mind, this is over 15 years, right? If we started this strategy when you're 25 years old, you'll be 40 by now. So it's actually a pretty long time, okay? So again, the cumulative return would be 232,000, right? Sorry, 232%, which is your year 15 carried forward balance of 488,213 divided by your cumulative investments over 15 years of 210,000. Now let's just rinse and repeat. So, in the interest of time, I'm not going to repeat everything I've just said. Feel free to rewind if you need a refresher, but I'm just going to do this all the way to 30 years, right? So, doubling this, right? And, wait, I'm going to go like that, and we need to change this. So, oh, I'm so sorry. Wait, sorry, this is wrong. Okay, so this was correct. Okay, I'm just doing this in a 5-year incremental manner so that it's easy for you to follow. So we're going to drag this here, and right. So just to pause here, by the end of year 20, we should have a balance of carry forward balance in year 20 of 1.3 million, right? On the cumulative investment of 420,000, representing a cumulative return of 311%. Right, and we're just going to do the same thing here. 2, right? Doubling again, so it's 8,000 now. And then we're going to, right, repeat the process. times 12, that's right. And drag this to year 25. Okay, you guys, sorry. Oh, right, sorry, I forgot this. Right, you guys know the drill by now, right? It's a 39% return on top of your investment of 840,000 of savings contributed to the value investing portfolio so far. And the final 5 years, it will be this times 2. Sorry about that. Okay. So again, right, it may seem like a lot, but by this time, by year 26, you're already 50 years old, and asking you to contribute 16,000 of savings per month is not a huge ask. Okay, it's a reasonable ask. It's not easy, but it's not impossible. Keep in mind, these are yearly figures, right? Sorry, these are monthly figures. Okay, sorry. So we're just going to do this again. Okay, so by the end, according to our calculations here, by the end of year 30, when this value investing strategy ends, you should have a carry forward balance of 7.8 million, right? At the end of year 30, assuming you have managed to achieve a long-term return of 15%. So as some of you might know, value investing is a long-term strategy. In some years, you might have lower than 15% returns. Some years you might have higher than 15% returns. But on average, this assumes an average 15% return. Okay. And you would have saved a 1.68 million by now. And you would that represents a 469% return, right? On your on your cumulative investments of 1.68 million. Wait, sorry, I'm wrong here. Okay, I need to go back and edit something. Right, so we need to actually include the previous years. Alright. And finally here. Alright, so I apologize, but I may have made a mistake for these 3 figures. But these are the actual correct figures, right? So you have made a total investment of 1.89 million, and you have earned a 15% compounded annual growth rate on that, and which results in a carry forward balance at the end of year 30 of 7.8 million, representing a 470% return, cumulative return over 30 years, right, on that balance, on that investment. So obviously, sorry, this 7.8 million represents the nominal amount. So the nominal amount is the pre-inflation amount. As you all know, inflation erodes the effective purchasing power of your money every year, right? So like I've said before, the assumption here is just 4%. So I'm just going to come here to do a shortcut. Okay, right? So we're assuming a 4% average long-term CPI, which is what the historical CPI was. You guys can adjust this as you wish, right? So the compounded, so similarly to our compounded annual growth rate or CAGR of 15% for our value investing portfolio, inflation also has a compounded annual growth rate over 30 years, right? And obviously this is not the most accurate thing, but we are just using very rough figures here. So, right, in the interest of time, right? So trust me, this is the CAGR formula. If you need a refresher on it, please feel free to Google what the CAGR formula is. Sorry, 30, right? So this is something that is readily searchable on Google, right? If you want to verify. So what it's trying to say is that after 30 years worth of 4% inflation, the effective purchasing power of your money is reduced by 324% or 3.24x. Okay, which means that this 7.8 million of nominal carried forward balance at the end of year 30 actually has a true purchasing power, right? Again, this is a oversimplification of just 2.4 million. Just. So, but the point I'm trying to make is that it's not, an effective purchasing power of 7.8 million. In 30 years' time, so that's 52, right? Yes, 2052. Your $7.8 million of carried forward balance in your value investing portfolio will only be able to buy 2.4 million worth of real goods and services after 30 years, right? Owing to 4% of historical inflation, or rather future inflation. So, right, that's what you actually end up with on an apples to apples basis. Then, by this time, if you started this strategy when you were 25 years old, you'll be 55, right? And ready for retirement. So naturally, this will serve as your retirement portfolio. And you could, divide. So personal finance also has another principle called the 4% rule. Basically, what it means is that you take your savings, right, and you reallocate it towards more traditional, safer investments like bonds to yield a 4% return, right? And I know that bonds don't yield 4% today, but right, regardless, I'm not going to go in there. It's just called the 4% rule because of that, right? So again, right, quite coincidentally, it's also the same rate as the inflation rate of CPI, the CPI rate of 4% that we're assuming. So if we take this figure, right, and multiply it by the 4% rule, that means that we have an annual income of $97,000 if we were to invest this $2.4 million in safer investments and yield 4% return every year. So unlike the 15% return that we were saying we were assuming we could earn in the value investing stock portfolio, right? You're 55 years old now, you're retired, you want a safer nest egg, right? So you're only assuming a 4% return based on the 4% rule. And that results in an annual income, right, of $97,000 per year, or a monthly income of, right, $8,000 a year. So this $8,000 is basically what you get to spend from your 4% return without having to dip into your initial $2.4 million of principal, right? So if this 2.4 million serves as your retirement fund, you would, hopefully earn an interest payment or dividend payment of $8,000 per month, and keep in mind, these are post-inflation figures. So this represents actual purchasing power today, right, of $8,000. And, I'm not sure about you, but I think most middle-class people can agree that an $8,000 income is something that you can live comfortably on if you don't have any fixed expenses, right? And as I've mentioned at the beginning of this video, this value investing portfolio does not come at the expense of your mortgage payments, your car payments, your children's education fund. No, it is only coming at the expense of your luxury expenses, right? So by this time, by 55 years old, right, when you've retired, on top of having this $2.4 million in a value investing stock portfolio, right, you will also have a fully paid off house and a fully paid off car and a fully paid off, etc., right? Like I said, this value investing strategy does not require you to forego making following the beaten path of making traditional mortgage payments, right, to own a house after 30 years, right, or to own a car or whatever, right, that your peers are also doing. This is just $500 of savings for 5 years. So I would argue that that's actually not a difficult thing to do just from a savings contribution, right? You're just putting aside $500 from your take home pay every month at the outset and doubling that every 5 years. So at the end of 5 years, when you hopefully double your salary, I'm asking you to double your contribution as well, right? And then follow up 5 years, again, double that, and then double that, and then double that, and then double that. And I think most people can agree that this is not extremely challenging to do, right? It's a very reasonable ask, considering that the reward is coming up with a retirement nest egg worth 2.4 million in today's purchasing power, right? Post inflation. I mean, I'm not sure about you, but that's enough for me, right? And of course, this all rests on the assumption of earning a 15% yield. So you might disagree with that, and that's fine. That's my job to convince you. So please, visit the rest of my blog. I have two very long value investing articles, which looks to justify how you can achieve this 15% return with relative amount of certainty, right? I personally believe that value investing can help me achieve 15%, and I hope that it can also help you as well. So, I guess that's it, right? So, you result in a 7.8 million. Oh, right. Remember what the title of this post is? It's actually how to create $1 million stock portfolio with value investing, right? But what we actually ended up is a post-inflation value investing stock portfolio of worth 2.4 million, not just a million. So theoretically, right, we could actually go back all the way to year 24, or let's just make it simple, year 25, right? And still get the promise of this article, which is $1 million stock portfolio with value investing, right? This, so you would you could say that this is actually a bit of a conservative strategy because you're giving us 5 years worth of margin of error, right? Or rather, you could just turn all these into zero, right? And you still end up with a post-inflation value investing stock portfolio worth over $1 million in today's purchasing power. But obviously, that would mean your monthly income's a lot smaller. But I would still be delivering on the promise, right? So anyway, let's just restore that. So let's be conservative. Let's assume we've got 30 years. We're not cutting out 5 years. You still get what you want, right? Retire on very safe nest egg. So I hope this has been helpful to you. It certainly has been very helpful for me, because as you know, I am a true believer in value investing, the Warren Buffett way of investing in stocks, right? It's a very low risk, reliable way of generating the same returns. And as you see in my other articles, it actually doesn't earn less than most other investing styles. Most other investing styles also do not really promise more than a 15% long-term annual return. So I'm not so value investing is not actually worse despite it being lower risk, right? It has yeah. Please go ahead and read my other articles. So if you'd like to download this Excel sheet and play around with the figures yourself, just scroll down below. You can download it by clicking the link below this video, or if you're watching this on YouTube, where I've also uploaded it as a backup in case Substack doesn't work. Visit my blog at valueinvesting.substack.com, right? And find this post, and then click. Then you can download it from there. So if this has intrigued you, please feel free to click the button below to sign up for a trial and see what we can offer, right? So this blog basically promises to deliver 2 stock reports of actionable ASEAN stock ideas per month, for a price of $99.90 per month. And right, assuming the narrative of ASEAN being the next China is true, this is your chance to repeat the China economic miracle that has captured the world by storm, right, over the past 30 years. So yeah, sign up for a trial. Please also read the rest of my value investing reports. I have gone into great length to try and justify why this 15% yield is reliably achievable. And right, if you like what I can offer, we also have a Telegram group chat where you can get daily advice on markets in the context of ASEAN stock markets, right? So if you may happen to be located elsewhere, and you want market updates on what's happening in ASEAN stock markets because right you're following my stock ideas presumably, then you can ask your questions there and get a daily reply in Telegram. So right, that's also the perk we offer. Uh, I'll be doing a follow-up video next week, right? If you have any questions. So I'm sure some of you might have questions or want some clarification on this strategy. Please feel free to leave your questions in the comments below. And if you have any other questions about ASEAN markets or even US markets, right? I'm sure inflation is the water cooler gossip right now in your office. So if you have any question about stock markets in any regard, right, whether it's macroeconomics, whether it's why Facebook fell 25% in the greatest wipeout in stock market history, feel free to ask them in the comment section below. I'll be making a new video next week to address all these questions, and I'll try to respond to as many as I can. All right, I'll make a genuine effort to address as many as I can. And you can please, I would ask that you please help me return the favor by sharing this post with anyone you think might find this interesting, right? So everyone wants to create a retirement portfolio, right, on top of owning their house and owning a car. So if this you know someone who might find this useful, please share it with them, right? Hopefully it adds value to their life as well. And yeah, I'll see you next week. Thanks for being such a great audience. See you. Bye.